The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, Friday the 19th of December. Jeremy, welcome back. Good to have you here.
Yeah, great to be here, Gareth.
So we've got just under a week to go till Christmas. 5 sleeps, if my maths is right.
Yeah, but those of us at a certain age, it's probably more like 10 sleeps, isn't it, given the afternoon naps? But,
That's true. And the number of Christmas parties and Christmas drinks that have been going on. So yes, it's been a few more sleeps than normal. But yes, we're nearly there. So it's been an extremely interesting year. Rachel Reeves' budget relatively recent in that year, which has been a bit frustrating for many people, but lots to look forward to in 2026. But why don't we just wrap up the last week or so of 2025, talk us through what you've seen this week, and we can have a bit of a think about what's coming up next year. That's what's going on the last few days.
Yeah, it's almost like geopolitics, financial markets and governments and everybody else are trying to squeeze everything they can into this week so they can take next week off.
Yes, it's not just UK micro-cap profit warnings that are trying to rush out. There's lots of other stuff going on, yeah.
But as ever, worth keeping an eye on the RNSs that go out at 11 a.m. on Christmas Eve.
Indeed, yes, that's exactly right, yeah. We'll be watching for those. But yes, on the broader macro stage, there's been a bit going on there as well, hasn't there?
Yeah, so I'd say over this last week, we've had a data dump of macro news and several important interest rate decisions. We've had an oil price dump and then a recovery, largely influenced by the escalation of events in Venezuela. We had Donald Trump address the nation, and we had a significant European development in the support for Ukraine that emerged overnight, improving the outlook for a peace deal there in due course. So, yeah.
Belgium taking centre stage.
Well, yeah, we had a war in Belgium and they've pulled one out of the bag and they have emerged victorious this time.
Yeah, well, fair play. And it feels like a reasonable result then in terms of what the EU has done, what Europe has done, by not stealing the Russian assets as overtly as potentially was the case, but still helping Ukraine.
I think so, yeah. And I think they were playing with fire. And I don't think you have to be a Putin stooge to appreciate the risk to the market's confidence in our institutional framework and all the stuff that supports financial markets if politicians had decided to help themselves to Putin's assets, however tempting it might seem to people that those assets should be redeployed to support Ukraine. In that eventuality, you would quite easily see gold and other forms of non-government money go to significant new all-time highs in that scenario.
Yeah, no, it would have been a dangerous thing to do in its own right and a dangerous precedent to set.
Yeah.
So, yeah, it's good perhaps that they've stepped back from it. So maybe the European bureaucracy worked out well, the way they make their decisions.
Yeah, but I think even that aside, markets have been pretty volatile, particularly equity markets have been quite volatile this week.
True.
And broadly weaker. But the FTSE rose over the week. Bitcoin, which we've referred to before as sort of the bellwether of global liquidity, had a pretty volatile week, trading between $92,000 and $84,000, which even for Bitcoin, that's quite volatile. I mean, in the old days, Bitcoin used to have a weekly volatility of somewhere between 15 and 20%. But more recently, that's sort of 4 to 5% weekly. So, yeah, that's telling us something. The other distress flare in financial markets are precious metals.
Yes.
And as we've seen, gold has maintained a solid bid around the $4,200 to $4,300 level, below its all-time high, but staying up there. But at the same time, its sort of more volatile precious metal cousins, silver and platinum, both surged to new all-time highs in recent days. Platinum now within whisker of its $2,000 an ounce level, last seen very temporarily in 2008. So I think there are a number of things going on that are indicating increased volatility and increasing risks of financial market dislocation. One for the historians of financial markets maybe might like to contemplate this one, but this week, for the first time certainly in living memory and perhaps ever, you can actually buy a barrel of oil for an ounce of silver. And
Okay.
looking up when these two last prices almost converged in sort of living memory, shall we say, they've come close twice before, but never quite crossed as they have now. And that was in January 1980 and in April 2020. So on the first occasion in January 1980, US Fed funds were at 14% and heading to 20% for that March.
Ouch.
And the world was undergoing the sort of Volcker-induced global recession, which was slaying the inflation dragon of the 1970s once and for all. And US bond yields peaked at sort of the mid-teens and began the era that I think we've now seen the end of, basically, a 40-year period of long-term US bond yields going from order of magnitude 15% to zero.
Right. It was very tough medicine, but it worked on the long term. Yeah.
And April 2020, I think most people can remember, was the time when the world had been shut down and the oil price was heading to zero or briefly traded negatively.
Yeah.
So
special situation. Yeah.
even then, we didn't see the dislocation signal that I think we're seeing now. I think we got an ounce of silver is about $68 when I last looked, and a barrel of oil is sub 60. So this is perhaps signaling a dislocation or a period of increased financial market volatility that we'll have to wait and see.
Yeah. Certainly precious metals and those sort of real asset prices, as you say, things which aren't controlled by governmental activity, they are surging to all-time highs, or certainly sort of testing those highs, or in gold's case, staying at a pretty elevated level for a sustained period of time. So it's definitely saying that investors in those markets are expecting challenges during 2026.
I would say so, yeah.
Okay. What about closer to home? What's been going on in the UK?
Well, there's evidence of further loosening in the UK labour market. Unemployment rose to 5.1% during the 3 months to October. So unemployment is going up. Median monthly pay growth is chugging along, but fell to 4.1% year on year. So it's trending above inflation still, but easing. So all supportive of the MPC's rate cut decision, which happened on Thursday, which didn't really surprise anybody, I don't think. And we've had sort of subsequent to that supportive evidence for looser monetary policy going forward into next year. We had retail sales data, which fell marginally following a larger decline in October, and a lower than expected inflation print. So broadly, a continuing slowing economy supportive of lower interest rates. And in that context, I think it was slightly surprising that the MPC's rate decision didn't have a more dovish context in its delivery.
No, that's fair. Although I think there's been a lot of positive press over the last day or so, focusing largely on the mortgage market. I think there's a positive echo going around, perhaps, in terms of people's psychology, and that could bode very well, as Alistair Stewart was saying the other week, for the UK building construction space, or the housing market at least, for Q1 of next year. If people are expecting mortgage rates to come down, lenders are doing their best to gain or keep market share. And if that leads through to a more benign or more positive housing market, that could be quite useful for the economy.
I think that's true. And I think house building and companies that have businesses sort of related to housing market and house price confidence could have a good start to 2026 with the timing of the budget so late this year.
Yeah, there hasn't been time for people to react. So no, I think that's right. So that's certainly one to watch for the start of 2026. Okay. And what about the US? What's been going on across the pond?
Well, Donald addressed the nation. He told them that they had never had it so good, or at least this time next year they would.
Okay.
Things can only get better, particularly if he pays them what he is now terming a war dividend, which seems to be a check to be sent to qualifying citizens, presumably sometime before they vote in next year's midterm elections. And I think this is sort of flagging a general gist of US policy as we get into the midterm year for the Trump administration. The focus has been broadly on foreign policy, and particularly obviously with the Liberation Day tariff stuff as well. I think his focus has got to move back to domestic policy. And as things stand, I think the likelihood is he will lose control of Congress in October at the time of the midterm. So I think he's going to be focusing on that. What they have up their sleeve, what Besson has up his sleeve, is yet to be revealed. But obviously, key amongst the sort of armory is the new chairmanship of the Fed and the whole issue around the direction of interest rates for the US and for the West more broadly as we go into 2026. And I think that it really is the big decision for investors going into 2026 is, have central bankers done enough on inflation? Talking earlier about the Paul Volcker medicine for the inflationary dragon of the 1970s, the remedy so far for the inflation we've seen of the 2020s has obviously been nowhere near as severe as that. Now, the bulls will tell you it doesn't need to be, but we don't know yet.
No, that's true. It hasn't been such a short, sharp shock, but I would say we've had many years of pain.
Yeah.
But you're right. Whether that's enough to have properly slain the dragon of inflation, time will tell. And to your earlier comments, the real asset markets, things like gold and other precious metal prices and Bitcoin, are suggesting that those investors don't think that enough has been done.
Yeah. And as ever in all this, and I know I always come back to it, but I think events in Tokyo and events in Japan are worth keeping an eye on. And we've talked about precious metals and Bitcoin signaling things, but Japan is signaling something very different. Overnight, last night, as expected, the Bank of Japan increased their short-term policy rate by 25 basis points, took it up to 0.75%. But they also reported that inflation is still running at 2.9%. So its Japanese inflation has now spent 4 years above target. And unsurprisingly, 10-year JGB yields moved above 2%. And now this is the first time we've seen 2% Japanese bond yields at this level since 1997.
Okay.
And slightly confusingly, and I would say worryingly, the yen actually weakened on that news, boosting Japanese equities. So good news for Japan's stock market. But I think it indicates that the market is saying that the Bank of Japan's actions are too little, too late. Where that leads us, I don't know, but I think it's a thread that's sort of hanging there as we go into 2026 that needs to be tidied up.
Yeah, that's certainly worrying. If Japanese rates are rising, non-Japanese economy rates are coming down, that's going to ruin the carry trade, as we saw 18 months ago. And that caused a lot of trouble then.
Yeah, in an environment where Japanese rates need to go significantly higher than they are now, it is hard to imagine that the US and other Western economy policymakers would be able to bring their rates down across the board, i.e. short to long, across the curve, bring them down in that environment without resorting to accusations of monetizing their own debt. And I think this is all related to and tied in with what pressure the Treasury and the White House bring on the Federal Reserve and the politics around who replaces Jay Powell during the early months of next year.
Yeah, and that's a great way to come back to looking ahead to both next week and next year. As you said earlier, the key question for investors almost everywhere is whether enough's been done to cure inflation. And what we see from the States in terms of the new chairman of the Federal Reserve and activities around their own bond market, that will be very, very relevant to those conversations, plus what the Japanese are doing, of course. So do we actually have any data next week, or is it time just to hang up our stockings and wait for Christmas?
Tuesday, we've got some US Q3 GDP data, which are expected to indicate a slowing rate of growth of the US economy, and I think probably likely to encourage a more dovish outlook for US rates. But yeah, most people, I think, have done everything they need to do in the last 5 working days. And I think it's going to be very quiet next week. But as I said earlier, I think it might be worth just keeping an eye out for these last minute RNS announcements from certain companies on Christmas Eve.
Absolutely right. We'll also be watching for Donald Trump stealing any more oil tankers and whether he's able to enforce some kind of peace settlement in Ukraine. So there's lots of potential news to watch for. So good. Okay, well, let's draw that to a close. Jeremy, thank you very much. And thank you again for all your comments and contribution across the whole of 2025.
That's okay.
Looking forward to next year, starting off in January.
Have a Merry Christmas.
Okay, have a good Christmas and we'll catch up in January.
All right, bye for now.
Bye.
Brought to you by Progressive Equity.